Hello, Empower You, and welcome to another episode of Mortgage 101. I'm Cynthia with the Rebecca Foote Mortgage team, and I'm here to talk to you about conventional loans. So let's get started. What is a conventional loan? So, a conventional loan is a type of loan that is not guaranteed or insured by the federal government. There are the most common types of loans that people apply for. And there are two types of conventional loans, conforming and non conforming. I won't get too technical with you about the differences, but what you need to know is that conforming loans meet or conform to the Fannie Mae and Freddie Mac guidelines, while non conforming loans, like jumbo loans, do not. And I'll go over these briefly later. Who can use a conventional loan? Conventional loans are for non-specific people. Anyone can use them. They're also for borrowers with like limited cash on hand. There's an option for a low down payment. They do not have to put 20% down just to get a conventional loan. Conventional guidelines are stricter than VA or FHA when it comes to debt to income, though. So, conventional would be good for someone with a lower debt to income ratio. Now, here are the basic details. The minimum down payment for a conventional loan is 3%. And there are actually two ways to do a 3% down conventional because there are certain guidelines for one type. You can learn more about the two different types in our video 97% conventional on our YouTube channel. And as always, you are free to put down as much money as you want. Now, let's say your client has a good credit score, but just doesn't have a lot of cash on hand. Now, depending on the down payment applied, will tell what the maximum seller's assistance that they can receive. If they put 3 to 10% down, they can receive up to 3% seller's assistance. If they put down 10 to 25%, they can receive 6% seller's assistance. If they put down 25% or more, then they can receive 9% seller's assistance. Monthly mortgage insurance is required for any loan except VA, and for conventional, it's for any loan amount less than 20% down. Now, what this fee does is it protects the lender if the borrower were to default on the loan. Now, unlike FHA and USDA loans, where the monthly mortgage insurance is a fixed number, the monthly mortgage insurance rate is dependent on the loan to value, the borrower's credit score, and their debt to income ratio. Now, we have seen some conventional mortgage insurance rates at 1.2% because they are based on this criteria. Now, that could be a huge difference in monthly payments when you compare it to an FHA or a USDA option, which can really make or break a deal for a client. Now, if you want more information about mortgage insurance and how it affects the monthly payments, please check out our video, Monthly Mortgage Insurance Explained, on our YouTube channel. The minimum credit score for conventional loans is 620. Gift funds are allowed, but it must be from a relative. And there are no income limits for conventional loans except for the specialized 3% down program. What are the general property requirements? The property does not need to meet HUD guidelines, which makes conventional loans good for house flippers and any homes that might need some repair. The repairs can be done as needed as opposed to before settlement, like with government loans. And remember when I said I would talk about conforming and non-conforming loans? So the maximum loan amount for 2022 in the central Pennsylvania area is $647,200. This is considered the conforming loan limit, and this number changes every year. Now remember, this is the loan amount, not the purchase price. So if the loan amount is over this number, it would be considered jumbo. And here's an example of how it would look. If the home has a $650,000 purchase price and they want to put down 5%, then it would bring the loan amount to $617,500, and that would be considered conforming. Well, let's say it was a $700,000 purchase price and the borrower still only wanted to put 5% down. So that would be a $665,000 loan amount, That would be considered non-conforming or a jumbo loan, and those have different guidelines as well, and we're not going to get into that right now. So, but the borrowers do always have the option to put just enough money to bring it down below that conforming loan limit. It doesn't have to be a set 5, 10, 15, 20% down. Let's say you have a young borrower that doesn't have the best credit or they have higher debt to income than is allowed. Well, sometimes adding someone with great credit or higher income with little debt would help them get approved. So, conventional loans allow them to have someone else be a co borrower on the loan who isn't going to live there, called a non occupying co borrower. This could be like a parent or a sibling. And usually we try to let them know that this would be a temporary solution and that once they build their credit up enough and could be approved, then we would refinance the other person's name off of the home. And technically, there are no inspections required for a conventional loan, which means you could have a non contingent offer. However, we will not know for sure until the appraisal comes back. If the appraiser points out any deficiencies, mold problems, whatever, if it gets pointed out by the appraiser, then it must be addressed. So if the appraiser suspects mold, then a mold inspection must be completed before final approval is given. Warrantable condos are allowed. You may be asking, well, what's a warrantable condo? So, for a condo to be warrantable, the condo project has to meet specific requirements that are laid out by Fannie Mae and Freddie Mac. Some of the requirements are easy and obvious, like it can't be part of a timeshare. But some of the requirements do require some digging, like at least 10% of the annual budget must go to reserves. At least half of the units must be owner occupied. If the condo is found to be unwarrantable, then the client may be able to get a portfolio loan, but we evaluate these on a case by case basis. So, of course, if you have any questions, please don't hesitate to reach out to us, 717 609 4044. You can email us at teamrebecca@footcapital.com or you can contact us through rebeccafoot.com. If you enjoyed this content and would like to see more, please don't forget to subscribe to our YouTube channel, Empower You, or ask us about our Empower You boot camp. Um, Thanks, and we'll see you in the next video.